Good afternoon, everyone. Thanks for joining us today for this market update. We have Craig Rubrecht, Jeff Carbone, and Sean Bendazian here to give a brief presentation on the investment markets.
Good afternoon, everyone. Welcome to summer. Thank you for joining our webinar today. I am Jeff Carbone and sitting in for Cliff Hodge as he takes a much needed vacation with his family. As Ashley mentioned, is none other than Cornerstone's own Craig Rubrecht, our CEO, and one of the newest members to the investment management team, Sean Bendazian. So thank you, Sean and Craig, for joining me today.
Yeah, thanks, Jeff. Thanks for having us. It's a pleasure to be here.
Good to be here. Appreciate it.
All right. Well, since our last call, volatility has reared its ugly head once again as the S&P index fell almost 6% on a single day over about a week ago. And today, we're also seeing about a 3+% loss in the S&P. It's not all because of the rising concerns because of the number of cases or hospitalizations around COVID, although that is a big part of it. But it's a reminder of just how fragile the economy around the world really is right now. We've seen some recovery off those lows of a week and a half ago because of some positive economic data that came in on retail sales. But we also had the Fed, and we had some easing tensions between the China and US on trade. But as I would say, that was so last week because those tensions are rising once again. As we've talked in the past, depending upon which letter of the alphabet you want to use with this market, V, W, or U, it really comes down to this. If we see a V-shape recovery, then maybe the market will be considered cheap or cheaper overall at this time. That's not really what we're seeing in the data, and we'll go over that today. But if we see a W or a U, then it's really looking to be that this market is a bit more expensive than we would want or than we anticipate right now. And that's more in line with our data and the process that we're seeing, that this market is a little bit expensive. However, we remain focused on determining which outcome may occur, and we'll continue to remain patient and follow our process. So Craig and Sean, so let's get started with a little bit of a market update and go over the slides in terms of the market conditions right now.
Yeah, thanks, Jeff. And you know, obviously this slide, just continues to remind us of the magnitude of the drawdown in the market, bottoming out at the end of March and the recovery that you mentioned. I think it's, one of the takeaways for me as we were looking through the last month is, interestingly enough, from the end of May to here we are at the end of June, the market has been essentially flat. We've seen big up days, big down days, but overall the market essentially flat, and even the bond market essentially flat overall for fixed income. I think a couple takeaways though, we're seeing, no pun intended, gold shining a little bit, up 3% in the same period. And really the big star over the last month and a big part of this recovery has been technology. Sean, you were sharing with us and the committee some statistics not only on technology, but also just some statistics that you're seeing in the futures markets.
Yeah, Craig, absolutely. There's a couple of interesting things we've learned lately. First is from who the S&P gains have been coming from. And the S&P is now dominated by 5 large tech stocks: Apple, Microsoft, Google, Amazon, Facebook, stocks that have done unbelievably well through COVID. Those 5 stocks now make up 23% of the index you're looking at on the screen, versus only 11% 10 years ago. So we also did some research on when the S&P 500 has logged its gains. And since April 1st, the index has gained 505 total points. 475 of those points have come in the overnight futures market, which is just unbelievable. The regular 9:30 to 4 o'clock session you see on TV is only accounted for 30 points in the S&P since April 1st. So just a few things that, we'll continue to watch these figures and others and see if we can decipher any signals about where we're headed.
Yeah, Sean, on the next slide, Jeff was talking a little bit about valuation in the market. Right now, you can see the forward earnings, price to earnings ratio on the market is over 22 times earnings. And you just go back underneath that red line. I think that, just gives some context, right, for future earnings in the market. Again, just going back to the commentary that everyone's hearing around potential V-shaped recoveries, and our thinking. Again, we're going to get into some additional slides to look at some economic indicators and what it'll actually take for a V-shaped recovery to take place. And so, Sean, with that, why don't we go to the next slide?
Yeah, I'll take
and this is an interesting visual. Yeah, please, Sean. Interesting visual on PE ratios to unemployment.
Yeah, so sorry about that, Craig. So on the left-hand side, our price to peak earnings, which is one of the valuation metrics to determine how expensive or cheap a stock market is. On the bottom is the unemployment rate, and each one of these dots is a really neat chart. Each one of these dots is a monthly figure based on the unemployment rate that is given by the Department of Labor on the first Friday of every month. So you'll notice that the high majority of high price to earnings ratios in high stock markets occur in full employment labor markets. If you take note to the circled area in red, we have high price to peak earnings ratios along with high unemployment. So therefore, as the note says, this market is pricing in a fast return to employment, which all of our data sets unfortunately indicate is unlikely.
I think the next slide is interesting, Jeff. Maybe you can comment on some fund flows that we're seeing.
Yeah, that's Craig. On this slide, when you look at it from the flows, we've seen a pretty high flow into equity ETFs over the last few weeks, kind of going over 24 billion has moved in. So kind of showing a little bit of a contrarian. While things are a little bit more negative, money's been moving in. So when you look at this slide, you just see that 24 billion is coming in, and at the same time, when you look at the next slide, it's not just as we were talking about in previous calls, the Robinhood investors, or what we call the pajama traders, those that have been sitting at home and able to trade. They started moving in, but it's also now we're starting to see some hedge funds and some private equity managers starting to move in, maybe a little bit more on fear that that FOMO, that fear of missing out, and they may have missed a little bit of this run. But I also when you go back to, they also were the ones that were buying in September and October of 2018. And then December timeframe, we had almost a 20% pullback in December of 18. So sometimes we view that as a little bit more contrarian given what's happening right now.
Yeah, and Sean, I think that's a good segue as we start to talk about some of the economic indicators. Again, going back to some of the things that we'll need to see happen, and maybe onto the next slide, we can start with the weekly economic index, and just kind of shows the magnitude of the decline. And just to give some commentary into this index, this is a basket that measures corporate bonds. It combines not only corporate bonds, treasury bonds, the stock market, but also the labor market, in addition to the credit market. Mixing those together. The next slide, Sean talks about leading economic indicators, and this, again, shows the severe downturn and subsequent upturn. The LEI is a little bit different than the WEIs. Again, something that we watch as an indicator for the economy, but a little bit broader than the WEI, because you have things like unemployment claims, average hours worked, You've got factory orders, manufacturing, building permits are in this number. Credit spreads in addition to the money supply. So you saw the drawdown, the subsequent recovery, and I think on the next slide, Sean, we kind of zoom out a little bit, because while the rebound has been significant, this chart, as we zoom out, gives perspective on just how much further we have to go to resume to pre-COVID levels, if you will. And again, it gives another visual as to what needs to take place for that quote unquote V-shaped recovery to take place on the economy. As we move into to the next slide, Jeff, you want to cover some of the statistics we're seeing on retail sales?
Yeah, Craig, I think it continues. When you look at the short term, some of the positive data that came in that I mentioned earlier was retail sales were month over month, were up over 17.5%. And if you can kind of see in April, we had, down 15, kind of, they were expecting it was a positive beat over 17. But so in the short term, we're seeing, positive recovery, but that's short. So when you go to when you kind of zoom out a little bit and you look at the longer term and you look at the next slide, it kind of shows that we're still year over year, we're still down over 6%. So while things in the short term, and I know Sean and you and I were talking earlier, when you turn on CNBC or Fox Business, they talk more short term, how things are, they'll 1 month it may be the worst, then it goes back to the best, and now we're back to the worst. It kind of goes back and forth. Short term, we're seeing, still some positive data coming in, but when you break it out over a long term, it's still, as you mentioned, Craig, we still got a long road.
And I know one of the interesting data points that we're reflecting on the next slide is the expiration of some of the unemployment benefits, and just kind of breaking it down to income earners. Jeff, maybe you can continue on with retail sales and talk us through this one.
Yeah, I think when you kind of go from the retail sales, so who is spending some of their money, and one thing as a reminder, as you can see on this slide, that the enhanced unemployment benefit, the extra $600 a week that was being granted for those that were unemployed, is set to expire on July 31st. So what's interesting with this slide is that if you take the top earners, and that would be where it says top middle 25 and the top 25, so the top 50% of income earners are kind of still not spending as much as they were, right? They're still being more cautious. They're saving, paying down debt, etc. While the lower income, the bottom middle and the bottom, so that bottom 50% is, because I'm not saying just because of the enhanced unemployment, but their spending habits, they're spending less, but they're still spending more than the higher, in which when you look at the consumer spending, a large part of the consumer spending overall is really in that top 50%. So again, when you kind of look at just the indicators of what's happening, the signs continue to remain, we're cautious, right? There's a cautious attitude among consumers. There's a cautious attitude among many investors as well.
John, you want to speak to just some of the things that we're seeing here in this chart that's covering weekly unemployment claims?
Yeah, absolutely. So, one of the most important key drivers and key metrics we look for in the economy is obviously employment. Employment drives spending, which drives the economy. One data point that we get a little bit more frequently than the actual unemployment rate that you get once a month are the weekly jobless claims numbers. And we are, continue to be at historic elevated levels, but the trend, fortunately, is lower. And, we'll see some more data on this tomorrow morning. And what we're looking for is for the trend to continue down. The last couple of weeks, although lower, there's been some deceleration in terms of the trend lower. So we'll get some key data on this tomorrow morning.
May coincide with certainly moving into phase two. I don't know if anyone on the call just saw the governor of North Carolina just spoke, and actually, I believe tomorrow, Thursday, phase two was set to expire and move on to phase three. And again, I just took a glance at it before the call, but I believe he's extending phase two all the way out until July 17th, if I'm not mistaken, on that data point. So the state of North Carolina, at least for those of you who are listening in the state of North Carolina, will remain phase two until July 17th. So just as an aside, but I think, we'll pivot now into the last segment of our call, some of the macro indicators that we're looking at. And I know that many of you on the call have heard us talk about the 4 quadrants that we're measuring in the growth versus inflation regime. And we are signaling a quad 3 environment. You can see that box is circled. And how we're approaching our equity allocation is that of somewhat of a barbell effect. That really hasn't changed with the offensive piece more focused on technology, which is prudent. You heard Sean earlier in the call talk about just the sheer percentage of the index that's made up by technology, but just seeing some continued earnings growth coming out of that sector. And then on energy, really beginning to recover. I think we have a few slides to talk about energy, but in a quad 3 regime, I would note that growth continues to slow in the U.S. economy, but inflation begins to pick up. That benefits utilities. And so again, in that higher inflation, lower growth regime, the defensive side of the equation is going to be with utilities, in addition to REITs. And we've been finding some interesting and unique ways to get exposure to real estate without getting direct exposure to office real estate, for example. And then on the fixed income side, continuing to focus on just investment grade credit and a little bit of government positioning. So just a few comments on the positioning and the regime that we feel that we're going to be moving into, and what the areas of the market that we're actually constructive on. So Sean, maybe go on to the next slide, Jeff, you can maybe comment on some of the macro indicators that we're looking at that support the reasons why we're constructive on quad 3 positioning.
Sure, Craig. As many, when I look on the list of who's listening and joining us today, many of you have seen a lot of these indicators already. So I'm just going to kind of move through them. And Sean, I'm going to have you move through them a little quicker with me. But as Cliff put these together, we the 10-year bond continues, really just bonds or interest rates in general remain low. We're in a low interest rate environment. When we look at, Cliff has talked about the high yield spread between treasuries and high yield bonds or lower graded bonds. We had it was all the way elevated back in the height of Corona or COVID, over 1,000. We've seen it come down right around 602 right now, the spread. So a 600-point difference, however, still remaining elevated. We see the dollar is kind of fallen back off. Again, a lower or more, gives us more pause and for caution, more defense, as Craig's mentioned, that barbell approach that we're continuing to follow. When we continue along, with a little bit of positive that we've been seeing, and this has been in the commodity. So we've talked about our defensive stance. We've taken some gold miners, some commodity funds. Gold is, I think, rising above 18 or hit about 1,800 today or in the last couple of days. So we're seeing the commodity play rise. At the same time, we're seeing oil come off its lows, right around that, just below 40 right now, about 37.70. Coming off a little bit right now because of the rise of COVID. The big users of energy One of the biggest would be airlines, which are still well off their peak. This is their peak time of year, but well off given what's going on with the virus. People were starting to get out and about, maybe not going on to Europe, but trying to get out to the beach, to the mountains, getting out and about. We're starting to, I know it doesn't take, I'm not filling my gas tank up every 2 months. Now I'm maybe every month, but we saw oil start to come back up. And then we continued along with, as Cliff has mentioned, Doc Coppers continuing to move up above that trend line, seeing some positive on the commodity exposure. Again, all quad 3 type of positioning from our process. Volatility started to come down. Wouldn't say below normal levels, but did dip. You know, you can see if that red line got really below 25. Again, came back up last week, came down a little bit, now back up around 30, just a little shy of 37. So again, all signs to remain cautious. We're continuing to follow our process. That gives us that barbell defensive approach that we're continuing to take. We've made some adjustments in the portfolio, trimming back on some areas that have had some big consumer staples, adding to, as Craig mentioned, into some of the tech, a little bit into some REITs, a little bit more utilities, et cetera. So we continue to make minor adjustments in the portfolio. You know, as we continue to kind of review and watch the markets, the economy, it really still remains to be seen whether the market gains can hold, especially as we've discussed, government stimulus, roll-offs of unemployment benefits, et cetera. The resurgence of the virus, and again, rising trade tensions, all things we got to continue to watch and keep a sharp eye on. We're continuing to work our way out of this economic hole that we're in at this time. And we're certainly looking and watching all signs and signals to see how long it may take. We will get out of this, but it may take some time, as we all have to remember. Craig or Sean, I guess just throwing it back. Any last comments from either of you?
None for me, Jeff. Thanks for having me on the call. And I think just for everyone who's listening, just a reminder, we'll continue on with the weekly Wednesday afternoon pace, I believe, through June.
Yep. So we are back. Cliff and I are back on July 8th for our weekly, now actually bi-weekly market update call. But also a reminder to make sure, you know, we're doing our planning calls. Andy Smith and Katie Jamil did one on 401k planning or 401k plans the other day. You should also be getting some emails regarding a little bit more entertaining and fun calls that we're doing. We did the how to make the best margarita and some learnings with on that, as well as some of the entertainers and music calls that we've had. So hopefully those have been enjoyable, as well as those some trivia contests we've been doing. So continue to tune in, listen in. We appreciate sharing that information with others that would like to hear of, again, whether it be market updates, how to make the perfect margarita, how to want to listen to some good music. Hopefully you're sharing those emails as well. On behalf of the Cornerstone team, I want to thank you, Craig. Thank you, Sean, for joining us. And we hope everybody has a wonderful 4th of July. Hope everyone stays healthy and safe. Wear your mask and social distance, everybody. Be safe.
Thanks, Jeff. Thanks, Sean.
Thank you.
Yes.
Thanks, everybody.